So how are trade wars affecting the ETF investing environment right now? So what's happening in the market right now is there's a consensus view that has come to the conclusion that trade wars are beneficial for the United States and they're not beneficial for international markets outside the United States, including emerging markets. We definitely disagree with this view. We think the view that emerging markets will suffer longer term from trade wars is not borne out in the data. It's not borne out in the long-term game. It's not borne out in the short-term game. There's sort of two factors that we think will actually propel emerging markets higher as a result of trade wars. The short game is that emerging markets are introducing a level of policy easing in response to the lack of confidence they see in the business outlook as a result of these trade wars. So that's the short-term game. The longer-term game is sort of a reorientation of what I call a post-American world economic order. So if the United States ceases to be seen as a place of reassurance rather than a risk, which it's being seen as, and a place that is difficult to do business, then what happens is markets outside of the United States tend to develop alternative systems. You can see that in acceleration of trade deals, you can see that in acceleration of payments and settlement systems, and you can see that in terms, ultimately, of foreign direct investment that's going to the United States, which has been in decline for the last 2 years. So short game and long game, actually positive for countries outside the United States. So the federal election coming up in Canada does impact the investing landscape for Canada. So Canada right now is suffering from what I call a brand problem. We have a brand problem globally. A perception of a place to do business in this country is negative, whether it's pipelines, whether it's government policies, whether it's a sort of a lower for longer oil view. So a change in government can obviously be a catalyst to at least lift that perception and that brand and come to the conclusion that we are finally a good place to do business. But it is a long way out from there. As a global investor, what you find is typically when a country suffers that way and the brand really decreases, it does take a long time. It takes many years to get that brand back. Amid greater volatility, there are great opportunities in the emerging markets. So every year there's going to be some headline risk, whether it's Brexit or the EU breaking up, and obviously the most recent one is trade wars. So the view that we have at Forstrong is that trade wars are indiscriminately selling off a variety of emerging markets. There's a lot of emotion right now in markets. There's a lot of short-term reaction to trade wars, and it's throwing up value all over the world. And ultimately, as a global investor and a global asset allocator, you have to look to places where there's a lot of fear embedded in the prices. And then the corollary to that is that fear justified? Is it backed by the data, backed by the causality, and backed by the future outlook? And ultimately, we think that emerging markets will be a great buying opportunity right now. So the next 12 months are going to be very interesting because the consensus views out here are all surrounding trade wars. So trade wars are supposed to produce a deceleration in the world economy. We're seeing that right now. And so predictions are pretty dire right now. We just had a survey out yesterday that suggests that the most crowded trade in the world right now is US Treasury bonds. So what that tells us is a lot of people are seeking income and safety right now. And they're not really looking to some of the positive impacts that could come through the data. So we talked about policy easing around the world. There's a variety of central banks that have engaged in cutting rates and reflating both on the monetary and fiscal side. And so we actually think as we come into the second half, as a result of this reflation that's taken place, really starting back in 2018 with China starting to reflate their economy, the second half could be a lot quicker in terms of GDP growth than folks are thinking. Not only stabilization, but maybe actually re-acceleration. And this is, again, focused outside the United States. The US is slowing down right now, and the rest of the world is actually speeding up. So the big surprise this year ultimately could be that second half is really good for markets outside of the United States.